Hey, it's Michael back with another video, and in this video I want to break down the 4 types of permanent life insurance because it's not always accurate to say I got a whole life insurance policy when you might have one of the other 3 types of permanent life insurance. So let's break down permanent life insurance and the different types right after this. Alright, I wanted to do a video on the types of permanent life insurance because a lot of times people use the phrase whole life insurance to kind of is interchangeable with the phrase permanent life insurance, when the 2 phrases, permanent life insurance and whole life insurance, they're not really interchangeable. Now, these days there's more than one type of permanent life insurance, and a lot of people don't have whole life insurance policies. So, it's kind of, I guess, in vogue to say, hey, what's the difference between term and whole life? When really you should say what's the difference between term and permanent life insurance, because while whole life is a type of permanent life insurance, it's not the only type. And I want to talk about these types. Now, in the beginning, kind of when they created life insurance, they created 2 types, term life insurance and whole life insurance. And term life insurance was good for a certain period of time, and then it ended. And so it was a little cheaper than whole life insurance, which was designed to last for your entire life and not expire and pay whenever you died. And so since you didn't know when you were going to die, they created a cash fund inside the policy and charged you a little bit more money to build up that fund so it would support itself your entire life and pay whenever you died, even though you might not know when that's going to be. So back then, when you talked about permanent life insurance and whole life insurance, they were kind of interchangeable because, that's what people owned, was whole life insurance for the most part. If they owned a form of permanent life insurance. Now, there's different types of whole life insurance. I mean, you have, how much you want, whether you want to pay like a single payment or for a limited number of years or to a certain age or just, for your entire life until you die. And obviously, if you pay it all at one time, you're going to pay more than if you just paid it all the way through your entire life. But the insurance company can calculate for you, okay, this is how much it's going to take to pay the premium all up front or over a period of time. And they would kind of guarantee how these policies would pay, what their premiums would be, what their face amounts would be, what their cash values would be, what the crediting rate on the cash values would be. And so if you had a policy like that, you had a pretty good, amount of confidence that the insurance company is guaranteeing everything. As long as you paid your premium, it's probably going to be okay. Now, that was fine until the early 80s when interest rates went really high. And when that happened, I think prime rate was like 21% in the early 80s, which, when you think about the low interest rate environment that we find ourselves in today, is crazy. If I remember right, CDs might have even been paying 15%. And so people look at these whole life policies and go, well, I'm only getting 3 or 4% or whatever the guarantee rate might be. And say, well, why am I leaving my money in this whole life policy? Why don't I take it out and put it into these CDs where I'm going to get so much more money? So there was a little bit of disintermediation there where money would, kind of tend to flow where the higher interest rates are to another type of institution. And that was the banks. And so insurance companies responded by creating another type of permanent life insurance to kind of make it a little bit more complicated than just saying permanent life insurance is whole life insurance. And when they did that, they gave people the opportunity, they tied it to short-term interest rates and gave them the opportunity to earn whatever the current market might be paying or close to it. And so instead of being limited to the guarantees that the old, boring whole life insurance policies offered, they instead gave people the chance to earn a much higher interest rate. And so, people could earn more money in these universal life policies. Now, when they did that, the insurance companies decided that, okay, well, if we're going to do that, it's a little bit more risk to us as an insurance company because we don't know what's going to happen. So we're going to kind of put more of that risk onto the policyholder, the owner of the policy, to if it doesn't pan out, they got to share in some of that risk. So, they didn't guarantee the premium for life anymore, and maybe they didn't guarantee the face amount or the cash value. And so it really just kind of depends on the policy. And I'm not saying that some universal life policies don't have some inherent guarantees in them. It's just kind of a simplistic thing to say that when they went from whole life to giving people an opportunity to earn more money, what they did was they took away some of the guarantees that the old whole life insurance provided. And then what happened is that in the early 80s, when interest rates were really high, they didn't stay there. Interest rates did decline, and over a period of time, people who did have these universal life policies discovered the insurance companies, they weren't so stupid in kind of transferring some of that risk of that happening over to the policyholders, because then the insurance company, the policyholders found out they needed to put more money in their policies because there wasn't enough in them to support them, because they were all based on the assumptions of much higher interest rates, which artificially lowered the premium probably lower than it should. Now, it didn't help that insurance agents also liked selling the universal life policies because they could give somebody a policy for less than the whole life insurance policies premiums were, because to guarantee all this stuff over here with a whole life insurance policy, you got to pay for that guarantee in the form of a higher premium. And so when they kind of took that guarantee away, they let people have a lower premium in exchange for that risk as well. So when that happened and people's policies kind of started not panning out the way they thought that they should, insurance companies responded again, and they created another type of permanent life insurance, and this was called variable life insurance. And variable life insurance, instead of being tied to short-term interest rates, was tied to certain sub-accounts that look like mutual funds or investments, where people could invest their money in the stock market or bond market or a fund that invested in those kinds of things. And theoretically, they could earn a higher rate of return than they would have in the short-term environment. But a similar thing kind of happened there, is that the stock market isn't just a straight line up. It is a cyclical thing. And I think I mentioned my own mom had a policy that was, she found herself in a situation that when they had some fine print in her policy that checked her cash value to see if it was enough to support the premium. And when it wasn't, they jacked her premium up, they tripled it, and she couldn't keep it anymore. So, policy she thought she's going to be able to keep her entire life or her whole life because it was a permanent policy. Because it was a different type, it worked a little bit different, and so she ended up losing that policy because she just couldn't afford it. Now, had she known that, maybe she would have just bought a permanent life insurance policy knowing that it was guaranteed from day one to kind of stay the way it was always supposed to be. But, it didn't work out that way. So I always feel like between those three types, you've got the whole life, the universal life, and the variable life, that if the insurance company isn't really willing to share this risk with you when you try and get a higher rate of return in your policies, and they know a lot about risk more than you do, why would you want to take that risk? Because if they don't want to, and they turned out to be pretty smart when it came to the early 80s, knowing that the interest rates couldn't stay there forever, why would you want to do that? So me personally, I like whole life insurance policies where I know I'm going to have a lot more guarantees than I am in some of these other types of permanent life insurance policies. Now, one last type of permanent life insurance policy is a second to die policy, which is a survivorship kind of policy that's used in estate planning. And I've even I was reading earlier about somebody who had a second to die policy that was universal life, and the person who was second to die in this estate plan, the spouse, who lived longer than the first spouse, lived so long that the policy didn't have enough money in it, and they had to put more money in the policies, and they didn't have it. They didn't know what to do to take care of that. So these fine differences in the types of policies are pretty important. And so, I feel like that a lot of people probably have a universal life policy, and they don't really have whole life. So, when you're working with people as an agent, or you're looking at your own personal policies, you want to look at what you've got. Now, personally, I like whole life insurance policies, but if you do keep on top of universal or variable life policies, or whatever kind of fancy policies they might create, like indexed universal life or some other type, as long as you stay up on these policies and monitor them every year, make sure they're performing the way they were supposed to, the way that they were projected to when they were sold by the use of an illustration, and you keep those values maintained, you'll be fine. It's just when you don't and you ignore it that those policies can be a problem. So those are the four types of permanent life insurance, and I hope you understand why now you can't just say that all permanent life insurance is whole life, that there's different types. So I hope that helps you out. If you like my channel, be sure and subscribe. If you got any questions about any of this, put them down in the comments on my YouTube channel, and I'll be happy to try and help you out. So I'll talk to you in the next video.